Welcome to the Common Bridge, where policy and current events are discussed in a fiercely nonpartisan manner. The host, Richard Helppie, is a philanthropist, entrepreneur, and political analyst who has over 1 million listeners around the world. The Common Bridge is available on Substack.com and draws guests and audiences across the political spectrum.
The economy's on everybody's mind, and here we are on the Common Bridge with a
Hey,
return
Rich,
guest.
how are you?
Good to
Nice
see
to see you.
my good friend Kerry Killinger. Episode 95 of the Common Bridge. This is in March of 2021, March 23rd to be specific. Mr. Killinger and Linda Killinger previewed their very well-researched book called Nothing is Too Big to Fail. I highly recommend their reading about economic history, what we're experiencing today, and especially what the future might hold. Now, Kerry Killinger is eminently qualified for this. His full bio will be on our websites. Be sure to listen on Mission Control Radio, subscribe on Substack, and follow us on social media and at richardhelppie.com. So, Kerry, back in March of 2021, we talked about inflation, the price of things over their intrinsic value in 6 asset categories. Yeah. And if memory serves me correctly, it was stocks and housing, commercial real estate, luxury goods, household net worth, and Chinese real estate. And maybe could we add commodities and food today?
We can add lots. And Rich, thanks for having me back. And it's great. And by the way, congratulations on your podcast. It's my go-to.
Thank you. It's
checking in every week to see what's going on in the world. And you just got some great guests, and I appreciate it. And I got my subscription into your new deal.
Great. Thank you
and
for
I'm
that.
getting broadened out beyond just the podcast to your update and reports and the different things you do. And so good luck. I hope it goes well for you.
Well, thank you. And we do have some really terrific guest columnists coming up. And later this month, February, we will be publishing our first newsletter. And what we're really hoping for is a lot of dialogue. There's a lot of rancor out there, and we think that we can discuss issues of the day as adults that have an interest in making this a better country and a better world.
I think you're doing a great job, and I think the country needs it right now. Let's talk about inflation for a minute. It was pretty funny last March when we were talking with you, and I'm fortunate to have my wife, Linda, who co-authored our book with me on that. And we said at the time, I remember saying, you know what, inflation is really taken off in this country. And the Federal Reserve had a saying that they were doing everywhere at the time. Don't worry about it. They said inflation is transitory. It's not for real and all that. And all of a sudden, the real experts at the Fed were just flat wrong. And what's happened is over the last couple of years in particular, we stimulated the economy so much to try to fight COVID, not only with the government going into huge deficit spending and all the safety net programs they put up and the like, but the Federal Reserve kind of almost went berserk in terms of how fast they grew the money supply, how low they kept interest rates in relation to inflation, and the purchases of assets they did themselves. They bought $4 trillion of assets the last 2 years. And guess what? When the Fed's buying all those assets, that drives prices up. And
they're not bargain shoppers.
They are not bargain shoppers.
Who'd have thought?
Yeah. So that stuff is really cool in the short run. It's kind of like, you take a drink, that feels pretty good. And you take 2, 3, 4, and 5. Well, the Fed got just totally drunk.
Oh. And
now we have the impact of it, which is runaway inflation, the greatest in 40 years in this country. So we have 7.5% inflation over the past 12 months on kind of everyday items that are measured in the consumer price index. But beyond that, the inflation that went on into common stocks, Bitcoin, NFTs, SPACs, all these kind of new speculative instruments were multiples of that. So all the asset bubbles that I talked about last spring that we were worried about have become even more inflated today. Now, I think the bloom is starting to come off that rose. I think that the speculative peak of all that activity may have been late summer for stocks and some of the more exotic instruments. And I think the peak of speculation may have been right at the end of the year for housing and some of the real estate things. And I think that we are now seeing the other side of that. That speculative boom may be coming off, and we may be headed for a fairly significant correction in some of those bubble prices.
Well, it's going to be a wild ride. And when I think about this on fairly simple terms, we put all this liquidity, all this new money out there. At the same time, we had broken supply chains. We had construction down because of COVID. So isn't that kind of basic economics? A lot of dollars chasing fewer goods. That's inflation.
It is. And one of the things I take exception with the government is they have continually come back and said, all these issues we're facing on inflation are just supply chain and COVID related. And no, these things are all a reflection of those crazy policies that the Fed put out, as well as the expansive policies of the federal government. They put way too much money out, too few goods for people to buy. They went out and just kept bidding up the prices. And in some areas like housing, where the Fed kept interest rates artificially low, that made affordability very, very good for things. And people got panicked, just kind of kept going out and buying and buying and buying. And then we had new players come into housing, like private equity funds and pure investors, and they helped really drive the price of housing up in some markets. I know
and the price of that house is outrunning wage increases. So people that are in the parts of their life where they're trying to get a down payment together, they can't reach it.
I think, you're right. And what's going to happen is everything we can tell is that interest rates are going to be going up. And the net result of that is affordability of housing is going to get less. And if that happens, then, we're probably going to see the other side of that and start to see supply come on the market for more houses and fewer buyers. And that could turn from a very speculative seller's market to more of a buyer's market, I think, in the next 6 to 12 months.
Is there any areas, any states that are more affected than others? I know that I've read things lately. Well, of course, California is always a discussion. Texas, what's going on there?
What's unusual with the housing bubble this go around is it's gone everywhere in the nation. And the average is prices have increased about 35% in the last 2 years. Remember, housing should only be growing at the rate of inflation, but about 1 or 2%. So when you have a 30-some% increase over 2 years, that's not very sustainable. Now, certainly some markets are much more vulnerable than others. Particularly worry about ones that don't have good long-term prospect, where their tax policies are not attractive and people are moving out of there and the like, and others where you just got into a speculative boom. So I would just target those markets where you grew much faster than 30-some% and saying they tend to be a little more vulnerable than those that didn't.
If I put on my cynic's hat or skeptic's hat, when I'm told that not to believe my lying eyes about those empty shelves that I see in the grocery store, and not to believe the price that I pay for a gallon of gasoline, even with my hybrid car. And then that same voice is telling me, hey, don't worry about this 7.5% inflation because it's only going to last a little bit. I have a hard time understanding, especially then the next thing is, well, we're going to raise interest rates. Now, you and I did business at a time when interest rates were market.
Yep.
And we've got a whole generation of people that have never dealt with the cost of money. It's going to be crazy.
It's certainly going to be a new transition for a lot of people to realize. Now, let me give a real simple truism, is that over the long run, the rate of interest rates have to be at or above the rate of inflation. Mm-hmm. And that's historically been the case. Whenever you keep interest rates way below the rate of inflation, you create these bubbles. And we've been through that. Now, the Federal Reserve has no choice today but to start reining that in. They have to raise interest rates or inflation is going to go just crazy, even from where it is today. And they have to stop putting excess liquidity into the system through money supply growth. And they're going to reverse their purchases of all these mortgage and treasury securities. And so all of these tailwinds that the stock market and housing and everything's had that's really helped fuel these bubbles is now going to be a huge headwind.
Thank you for listening or watching this segment of Richard Helppie's The Common Bridge. On Substack, you can access the full archive and bonus columns, podcasts, and interviews for only $5 a month. At Substack.com, search for The Common Bridge and subscribe.